Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, sales leaders, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and their Dakota Live content, please check out dakota.com to learn more about their services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker, who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or a recommendation of the investment advisor or its supervised persons by Dakota. And joining me from Dakota today is Chris O'Grady, Chief Investment Officer. Welcome.
Thanks for having me, Robert. Appreciate it.
Yeah, thanks for being here. It's nice to see you again.
Number two, I had a lot of fun on the last one.
Good. I was a little worried you might not come back, but you did.
Anytime we can sit and speak to somebody and learn something, I'll be here.
Good. Well, I'm happy to hear it. Well, I was thinking about you. I went to see Greg Isakoff last night at Union Transfer, and I think that was one of your stomping grounds. When you
Union Transfer, the Fillmore, and World Cafe Live. No other city's got 3 rooms like that for music, so good. It's always a great.
That's what we should start enticing our guests to come to Philadelphia, so we can get them into some of these live venues.
COVID's done that. I mean, COVID's kind of widened the boundaries of the ability to communicate and hang out. So we've done that with a lot of folks, and whether it's out and about or seeing a show or golf, et cetera. But that's the beauty of COVID. It's been a lot more familiar type of communication, getting together. So good. The old Spaghetti Works. Union Transfer is the old Spaghetti Works.
Yeah, that's right. Well, he's a good songwriter. He's got some lyrics that said, were we somewhere in between? And when I think about these markets over the past few months, it feels like that's where we've been, somewhere in between recession and something else. So how have your client partners approached this operating environment as they continue to navigate these market conditions, kind of this somewhere in between?
There's a lot of alternative allocations. I mean, traditionally, I'm speaking to Mark, and he'll talk about the classic institutional investing alternatives, but you're seeing more fragmented wealth intermediaries, whether it's a bank trust department, whether it's an RIA, a family office, a multifamily office, an insurance company with a little bit more of a retail focus. Everybody's trying to figure out, how do I invest directly into the economy and get a yield or get some sort of co-investment? And I think that's really, active management still tremendous, concentrated managers on the traditional side, but just this whole 40%, or whether that's going to be 40 or 50% fixed incomes, drifting into having an alternative focus to it. And people are really interested in finding out ideas. So when you have an institutional allocator like a Mark, he'll be speaking a language that a lot of these wealth intermediaries are speaking as well. It's just really finding the right strategy. And that seems the momentum started a few years ago. It's not stopped.
Yeah, I'm interested to hear those ideas. So we're looking forward to it. Well, I'm also excited to introduce you to our guest, Mark, in a few minutes. But before we do, I am happy to share we have a number of students today with us from Drexel University listening in on the Dakota Live podcast. I teach 2 courses on venture capital, venture investing, and early stage venture financing with the Close School of Entrepreneurship. And I have a few questions from students that they gave me in advance, so I'm probably going to try to slide those in at some point, Mark, just as an early heads up. But I'm thrilled to have the students with us here today as listeners, as I'm sure they're thrilled not to be in class today.
Well, Drexel's a great university, and hopefully there's a tuition rebate because they have to spend a few minutes listening to me. Oh, well, I thought college was going to be hard.
I think you're extra credit, Chris. I wouldn't worry about it. I think you're okay. I know Mark certainly is. Well, with that said, I am very happy to introduce our audience to Mark Steed, Chief Investment Officer of the Arizona Public Safety Personnel Retirement System. Mark, welcome to the show.
Yeah, thanks for having me. Looking forward to it.
Yeah, we are as well. We're grateful for you to take some time to speak with us. As Chris had mentioned, we're excited to hear your ideas. I know it's been a very busy few years for you as you've taken over as the CIO at Arizona, and we're going to get into that in a few minutes. But before we do, I want to quickly share your background with our audience and students. So Mark began his career for PSPRS as a portfolio analyst in 2007, starting as an intern. During his ensuing rise through the ranks, Mark has managed each of the PSPRS portfolio assets, including private equity, venture capital, fixed income, absolute return, private credit, and global trading strategies. In 2019, Mark was promoted to Chief Investment Officer. The Arizona Public Safety Personnel Retirement System provides a uniform, consistent, and equitable statewide retirement program for Arizona's public safety personnel. PSPRS provides retirement benefits and programs to nearly 60,000 active members, retired members, and surviving beneficiaries, and to more than 300 employer groups. Mark has been named by Money Market Intelligence as one of the U.S. public pension sector's rising stars. He's played an instrumental role in transforming the plan's $17 billion in investments from a traditional stock-heavy portfolio to a modern, highly diversified set of investments built to withstand market volatility while delivering significant returns. Mark holds a Master's of Science degree in Predictive Analytics from Northwestern University and an MBA from the Arizona State University's Thunderbird School of Global Management. He earned his bachelor's degree from BYU, where he majored in Latin American Studies with a minor in Business Management. We're going to speak, Mark, to you in more detail about predictive and behavioral analytics, and we're excited about that. But I wanted to highlight your experience in a 4-year project as a forecaster for the Good Judgment Project, led by behavioral economist Phil Tetlock, who is part of the University of Pennsylvania here in Philadelphia. We can't wait to learn more about how you've carried that experience through your career. So we're excited to have you here. Congratulations on all your success.
Yeah, thanks so much. And preemptive apology. I've got remodeling going on at my house. And I think that the point was brought up earlier that COVID has just brought humanity kind of back to the business. So I can't promise that I'm in a spare room. I always feel bad because there's, you expect there to be something stimulating in the background. There's not. There's a door.
So I was listening to a wonderful podcast you did with Afin Devitt, CIO of Moneta Group, called the 50 Faces podcast. It's really a wonderful investment podcast if you get a chance to listen to it. And I really enjoyed it because you ended that show talking about your time as a younger person, and we've got a lot of younger people on the call today, in ensemble choir. And you gave this great story about how you were part of this choir and you guys were singing your song and a cell phone went off in the audience and it slowly threw the entire ensemble choir off key. And before they knew it, the whole choir sounded like a cell phone. And I couldn't help but draw another parallel to the financial services market, that it's a noisy world out there. And how do you ignore cell phones ringing in the background, construction downstairs or upstairs, and keep that choir on key, Mark, especially as a CIO from a management perspective? How do you shake out the noise?
Yeah, it's a good question, but I think that's kind of what I love about music. It can look so like subjective, but there really are like notes and melodies, right, that are just objectively more pleasing to the ear. So like, in other words, there is like a system or a machine, if you like, kind of lurking in music. And I found actually that in like most forms in life, there is kind of like, including financial markets, there's a machine. And if you figure out how the machine works, you can kind of separate the signal from the noise. So I think like, somebody who teaches, venture, where does like innovation fit in, right? With, so if we're like machines, what are we talking about here, right? So I'm not talking about like Newtonian mechanics, right? Like clockwork, right? We're talking about sort of biological systems that adapt. But even though these systems are adaptive and they learn, there still are rules. And so I think it's all about like learning the rules, and like what's really going on here. We've got different markets and different strategies, like what's really at work. And I think that's what it's all about. And so we spent a lot of time trying to pull apart the machine. I think Ray Dalio of Bridgewater really kind of coined that term. And we take that to heart. And I'm sure at Drexel in engineering school, that's something that might resonate too.
Yeah, absolutely. Well, for those Drexel students who are listening in today, it's wonderful to know you started with Arizona as an intern. Dakota is in the business of keeping track of where people come and go in our industry as part of the services that are offered on Marketplace. But you're one of the increasingly rare people who have had longevity with one employer. So could you share why the plan has held your attention for all these years, and what about the role keeps your fire burning?
Yeah. So, I think like a lot of things in life, it's an accident, and you just kind of keep rolling with it. I ended up at Arizona because I have 3 children, 3 boys. My eldest is 20, also in university. And my two oldest boys have hemophilia, so that means their blood doesn't clot. But 20 years ago when he was born, the health insurance landscape was a lot different. And there were only so many employers that would actually not require me to pay 20% of like the copay for his medication, which would cost like $1 million a year. So I was gonna have to pay like 200,000. So there are very few jobs, right? I kept like my first question when I was interviewing out of business school was like, can I see your insurance policy? And they're like, just talk to HR. And I'm like, no, not that person. I need someone, up the chain. So it was really kind of random how I ended up there. I was working at JP Morgan Chase before when I didn't have kids, right? So coming out of business school, I took the job as an intern with my current employer. And I always thought I just, so I took the job honestly because they covered the health insurance for my kids and it wasn't gonna have to pay 20% of the copay. I remember the CIO at the time saying one time when I was like frustrated, he's like, hey, do you feel kind of like tortured? Like you're here because, like you kind of had to take this job for your kids and, you just seem frustrated. And I was like, yeah, that's exactly why I'm here. Right. I'm like tremendously honest about it. Like, that's why I took the job, not why I stayed. So I always kind of figured that I'd stay for kind of the 5 years and then do something new. But when I started, I was building the private equity and venture portfolio. So they were 100% stocks and bonds, right? I guess like in life, I've sort of figured out you can either get in the starting lineup of a lower league team, or you can sit on the bench of a more elite team, right? And I wanted at bats, and Arizona public safety was going to give me a lot of at bats, and so I just took that. So I started with private equity and venture. And then I was rotated over into credit. And I know there's maybe a question lurking later about just kind of asset class rotation, right? But I found like as long as you stay somewhere and you continue to grow as a professional, so you're not doing the same thing for 10 or 15 years, right? It's constantly, you might as well just stay there. And I never thought I would, but eventually, you build a track record and many people admire that track record. Even people that are coming in, because we're governed by a board of trustees that are prejudiced not to like you if things aren't going well, have to take a step back and say, that's credible. And so I always just found a home that eventually you sort of look at the whole portfolio and it kind of feels like a child after a while, right? Like there's so much of you manifested in different parts of it that, I just stuck around and, I'm still surprised. Like, it is a, dream job. And it's like, like you pinch yourself every day. It's incredible.
That's wonderful to hear. I appreciate you sharing all that and sharing that information about your family. Benefits are something I think we all kind of take for granted, and you're in the business of being responsible for a lot of pension obligations. So it's nice to hear that personal side of it. So thanks for sharing.
Mark, on the personal side, in terms of hemophilia, there's been some medical developments, right? I mean, I know whether was it the old factor VIII from Baxter or a lot of these clottings, the pig plasma and things like that.
So I'm impressed. Yeah.
Have you seen? I know a friend was working in the pig plasma type of product, and friends at Baxter. I spent some time in Chicago, but from when your children are born and now 20, it's like the Steve Jobs statement: "I'm going to be the first to outrun this or the last to succumb to it." So, have you seen medical developments on behalf of the efficacy for your children?
Yeah. So what's funny about that is there have been tremendous developments when my kids were born. So anyone who's our age, to the extent they're still alive, right, that has hemophilia, usually has HIV or hepatitis C, because up until I think 85, 86, right, they were doing blood transfusions, right, and then you had sort of like the whole tainted blood and the Ryan White story and all of that. So that's really humbling. There aren't a lot of people like in their 50s and 60s and 70s, right, that kind of made it through okay. And so when my kids were born, they had to infuse. We had to infuse them in a vein 3 times a week, and that's always really kind of unnerving as a parent, right? You're trying to do the school thing. Kids wake up, they don't have very good veins. You're trying to stick them. Nobody likes shots generally, but it's even worse when you're trying to find a vein. And sometimes we have to stick kids like 2 or 3 times, right? And so fast forward, because like the medication, as you said, like they took factor VIII. So think of like the clotting cascade as like a relay race, and they're kind of missing one of the people in the relay race. And because you're missing one person, right, then like their blood doesn't clot at all. So we have to infuse them 3 times a week. And that medication had a half-life, right? So that's why you had to do it. So the plays since then have been extending the half-life of the medication. But there's also been some genetic therapies that other groups are working on. In fact, I think BioMarin had one that was expected to be out a year or 2 ago, but I think might be out later this year. But I'll tell you what's interesting about that in my job is when BioMarin was presenting the original announcement that they anticipated, I think back in like 2019, that the genetic therapy would be released, effectively like curing your kids. It's like, like I'm getting emotional, like as a parent, right?
No,
They're like, my kids are like, wait. They're like, hang on. Like we might be like cured, right? Like that never occurred to anyone. And it was like the weekend before I interviewed for the CIO job at Arizona. So I was up against it was the final interview, and I was up against two other sitting CIOs, right? And I walk in and I'm like, like, I don't care if I get the job or not. My kids are going to be cured. And it was probably the best interview I ever had because I could have cared less. So long answer to your question, but yes, there's been some tremendous advancements.
No, we live in a country where, people can criticize our country, whatever, and there's great things and bad things, but the great things are what you just talked about, just the developments in medicine and the brain power and everything like that. And it's just obviously when you're in the dead center, David Quinn, that is the coach of the San Jose Sharks, is a hemophiliac, and he had to suspend his hockey career because I had some friends I played some golf with David over the years, and around some friends that knew him really well from Boston University, and he'd lace up his skates and start bleeding. He's a first-round draft pick in the NHL and had to give up his career. So it's nice to hear that there's progress being made.
Yeah. It's not all doom and gloom out there in the world. A lot of positivity.
And let's focus on it.
Agreed. Well, these are the days I wish this podcast was 2 hours and not 40 minutes.
Well, this is the important stuff. I mean, in terms of developing relationships with people, this is all that matters. And then the other stuff happens.
No, I couldn't agree more. I'm glad that we're having this conversation. And Mark, we really do appreciate you sharing all that. I think a lot of people in our audience will as well.
Absolutely. Wonderful humility.
Well, you've taken, getting back to the seat that you're sitting in from a CIO perspective, I really admire the fact that you've taken an innovative and relatively disruptive approach to how you've tackled the challenges of the plan. So when you took over as CIO, I know you were faced with a myriad of challenges that were quite well documented. How did you strategically map out how you wanted to implement the changes that you saw that were going to be necessary to kind of effectively right the ship?
Yeah. And when you say like well documented, you're not kidding. Just as an interesting side note, I think for listeners, I would caution anyone to be suspicious of any claim really a reporter makes about government employees, because public employees, little known fact, and public agencies are not covered by like slander and libel laws, right? So reporters can say pretty much anything they want unless they like actively, knowingly like say something that was wrong. So the bar is really high. But so the reputable groups, like the large players out there that some of us will read, they'll thoroughly vet stories and they'll actually attribute stories to you see names. But anyway, that's as an aside. I think that's just one of the interesting learnings is to be very suspicious of that, because the bar is much lower for reporting on public agencies. Anyway, as you can imagine, stepping in 2019, effectively as a CIO, kind of had I think we were waiting for some new trustees to show up. I'm governed by a board of trustees, and I think there were some that were rolling off and some that were coming on. So obviously there's low hanging fruit, right? And I know there's students listening, so I'll try to give some examples, that might be a little more palpable for them and just not talk kind of in vagaries. But like things just like weren't working, like routine meetings that you would think happen every Monday. We're not happening on Mondays, right? The obvious stuff, like just regular logistical meetings weren't being held. Everything was like on spreadsheets. It was a very analog. Underwriting processes were pretty inconsistent. And keep in mind, right, that we're investors, and we do a lot of on-site visits, and we see different processes and systems and cultures. So we have, I like to think a good investor has a pretty sensitive BS meter. And so, that's the lens, right, that I have. And I always ask myself, like, what would happen if we had an external investor sort of come in and start like asking questions, right? And then it was just kind of classic, what is easy and cheap, right, versus expensive and hard. So you started with investment policies and kind of asset allocation, because that's cheap. And then, that's kind of the former. And then you had like systems that we needed and processes and people. And those took, longer, and some of that stuff we're still working on, but that's how it started.
I read somewhere that you said we basically took a scalpel to the actuarial model. You wanted to equate portfolio volatility to the contribution rate volatility. So for those public pension allocators listening, to the episode and thinking about their own plans, what lesson did you learn through that exercise that you share with your peers?
So one of the things I think that's important is so imagine walking in, we have an investor walk in, and the first question is what do you invest in? And then why? Right. In other words, right, for the sophisticated investors that are listening, right, your portfolio, we all know, is a function of kind of your risk appetite, but people assume that pensions are all kind of the same risk, right? And your portfolios should kind of look the same way. So it's one of the most difficult questions to answer, if you want to see an investment team squirm a little bit, right, is asking, why is the risk that you're running the risk that you're running, right? If we define it as standard deviation, which a lot of us like to do, it's well, let's say it's 15%. Why is it 15%, right? And so that was that when I say it starts at the top, that really was the initial question. And so there's the impact that kind of for people and businesses, that I'm getting kind of around to the question here, a different direction. For people and businesses, you have sort of income impact of decisions, right? The income statement kind of impact, expenses and revenue, right? And then you have sort of balance sheet or wealth, wealth considerations, right? I mean, does it impact my income today, and does it affect my wealth? So obviously, when returns fall short of expectations, so actuaries will make assumptions about return expectations. Ours is 7.2%, but some groups have 6.5%. Some groups might be at 7.5%, but generally somewhere in that range. If you fall short, someone has to make up the difference, and that's usually the participants, and their contribution rates have to go up. So that's kind of an income statement problem, right? And then you have the balance sheet problem. So we figured out what happens if you run with a portfolio that has 15% volatility and you crunch it through the actuarial process? How does that actually impact the contribution rates of our members? Because you can't just keep raising them to the sky. Theoretically, we figured, right? Everyone has a limit, right? It's not the people that pay in are police officers and firefighters and the cities and towns, the employers. So they don't have unlimited resources. And actually, what we figured out was because this is what's really interesting about pensions. They'll smooth your returns, right? Because they want to smooth contribution rate volatility. So they'll kind of smooth your returns over some period of 5, 7, 10 years. Meaning they'll kind of assume you'll make whatever 7.2%, and then the spread above or below that they'll give you. If you have a 10-year smooth rate, 1/10 of that, and you'll book 1/10 this year, and then 1/10 for the next kind of 9 years right after that. What we figured out is once you do that, and then if there is a liability that's created, you amortize that liability out over some period of time. Depends on the pension, but it could be 15 or 20 or 30 years. That standard deviation of let's say a 15% portfolio really translated into a 1% standard deviation or lower for contribution rates. So the takeaway was actually risk is not our problem. And I don't think it's a problem for most pension funds. You could actually assume a lot more risk in the portfolio. And everybody was running around worried about, sort of the endowment model and being balanced because of what happened in 2008 and 2009, everyone was in stocks. But even if you're super risky in stocks and you crunch it through the model, what we discovered was actually the impact on contribution rates isn't actually that high. It's, your focus should not be on the investment program. One, if you're a constituent, that's sort of one takeaway. But for us, it was we can embrace risk, and risk is one of those. It's those words that I think gets misused a lot. But that was one of the big takeaways we had.
Hey, Mark, how much goes out a year in terms of payments to pensioners?
So it's a good question. We're probably close to about $1 billion a year.
Wow, that's unbelievable. It's, basically what, 5.5% of the portfolio, 6% of the portfolio?
Yeah.
So there's your bogey, kind of that 5.5%, 6% range that we always talk about with endowments and foundations. So it's funny how that math works. No, you sit here, $17 billion. Us as sales professionals that are trying to market interesting asset classes to CIOs like yourself. I mean, you're not in front of your Bloomberg all day, every day looking for ideas. So this is almost an aircraft carrier. Short of chaos and distress, and I know obviously the most chaotic time in the last 2 years, it was about a 3-week blip before the government got involved. What what drives you to decide of an exposure that could really move the needle on the portfolio? And then probably the first question I should ask, with the backup in rates that we've seen with discounted liabilities probably being less and less, are you closer to a more comfortable funding status to the point where you can just immunize the whole portfolio?
We're not close. When I started as CIO, we were about 45% funded. So we were one of the lower. Now we're about 60, I'd say mid 60s. Okay. And I'm averaging because we're I think the only, or one of the only pension funds in America where we're actually the sum of like 250 individual pension funds. So all the cities and towns actually have kind of their own system. So I live in Gilbert. Gilbert could be 80% funded, right? But Phoenix could be, 50% funded. You got Scottsdale, it could be 110% funded. So all the for the asset purpose of the asset allocation, right? They all get kind of pooled together. But interestingly enough, I think their consultant surmised, and I think he's right. At the end of last fiscal year, which would have ended June 30, 2022, I think we're the only pension plan in America whose assets went up, and they went up in value, even though our portfolio was pretty flat, slightly negative, which was a good return for us, right? Relative to the average, it was probably down 10%. They went up because the cities and towns decided it was smart to kind of finance at 2 or 3% and then pay off their unfunded liabilities. So even though we're paying out, we've actually been cash flow positive, and that's been a huge boon for our program, right? For the last 2-3 years. So our assets are actually up to about 18.6 billion, as of I think maybe last week. So that's where we're at from just kind of a macro position. To the question about kind of selecting investments, I think fundamentally, at the expense of being really vague here, the question we're asking is why do we need this, right? Keeping in mind that we have existing investments, right? The portfolio is funded, just setting aside cash for a second, right? The portfolio is, we've got investments all over the place in companies and in funds, right? So what's the point in adding the nth thing, or are we adding this and taking something out, right? Is it increasing return? One thing I'll note though is this issue of diversification. So I think diversification is a bit of a dangerous word because it becomes, I found, Frank, just practically an excuse not to make decisions about something specific. But recall what I said about risk and how the pensions can take on more risk and can assume it. Okay, so basically there's a multi-stage process. So we will diversify if it doesn't come at the expense of return. So if you have two things that are completely separate but volatile, right? That's great. If you can add something to the portfolio that's diversifying but has theoretically no correlation, right, to anything else in the portfolio, which we all know is really hard to find, right? Then that's kind of nirvana. But what we're not interested in is saying, look, the goal take private equity, right? And let's just say, just for sake of argument, that your return expectation for private equity is 15%. And you've got this group over here that you think might get you 12 to 13 or 14, but they're kind of a safe pair of hands. That's a discussion where in the past, our group and other groups might say, well, they're diversifying, or look, there's a loss ratio. You start coming up with these arguments, right? But there's no reason to diversify. Again, we can assume because we've done the foundational work, we don't need to diversify the risk out of the portfolio. If the risk-free rate is 4.5% and we have to hit 7, right? Or you want us to beat our peers, we're going to have to deviate and do something different. We're going to have to take some risk. I kind of skirted around the sort of the process question. So you can assume there's a multi-stage process, but really what we're trying to do, I referenced the machine, and these themes keep coming back, and we're just trying to understand how the investment works, right? And really it is, whether it's a business or a fund, right? A single stock or a fund or whatever it is. Can you explain it to a high school student or a college student? And maybe not that basic, right? But you kind of get my point. If it's a fund or a manager, we might effectively, we're effectively kind of outsourcing, just for the students that are listening, it's kind of outsourcing part of the management, right? We're going to ask a lot for a lot of data, right, about their deals. We're going to ask about revenue at current levels and the most recent quarter, right? We're going to ask about EBITDA at acquisition, right, and at the most recent quarter. We're going to ask about debt and LTVs, and we're going to compare those to see what, if anything, is special about performance. back to the sort of the signal and the noise question. So for example, 5% EBITDA growth in one company might sound good, but not if the peers did 8%, right? And the other way around, 8% might sound amazing, but not if you knew the range in the industry was anywhere from minus 5% EBITDA growth to plus 20, right? Then it's like, oh, okay, it's, median was 5, year to date, that's okay, right? And we also have a consultant because we have a lay board who will look over our shoulder. Sometimes they'll be in front of us because they had a client maybe that asked them to do some work on a theme or manage our fund. And then we'll take their work and supplement what they've done. But that's basically how the process works.
Another interesting attribute of your process, which is differentiated from some of your peers, is that I understand your staff rotates asset classes, that you've got kind of Jacks and Janes of all trades rather than masters of one asset class. Can you talk about why you've taken that generalist approach? I think it's an interesting one. And I think for our audience, we'd love to hear how that's been going.
Yeah, that was a tough one because, the first time I was rotated out from private equity and venture into fixed income and credit, everyone in the market assumed that I had done something wrong and that I screwed my job up. So it was like,
banished to fixed income, roll the T-bill portfolio.
yeah, exactly. So you're like, no, I didn't do anything wrong. And actually, it's fine. But that's really hard to do because I think from a learning standpoint, it's important. But you also don't want team members getting really close to investments, right? And I think it's good just risk diversification for the for the pension fund. But it's also really hard. It doesn't, you worry about like how you present the fund to outside parties. And if you have a guy that was just doing private equity venture sitting in a meeting about structured credit, who obviously doesn't know what he's talking about, that doesn't reflect very well on the organization. But, as we did it, I think we started doing it in 2011, I think. I've seen the benefits of it, and I think it's kind of worth the risk. And so, frankly, we all know that the markets are related. And we look at the world through kind of the 4 major markets, right? Equities, fixed income, currencies, and commodities, right? But some investments can have like the same risks, meaning like the same statistical like distributions, right? In terms of just how volatile they are. Well, like how do you optimize returns or even, know that their distributions are kind of statistically the same or the risks are the same if you maroon somebody for their whole life in fixed income or equities. So while we're always going to keep a certain amount, right, per our investment policies and all of the asset classes, we do have ranges to kind of move. And we just think the generalist model is the best way and consolidating asset classes so that you have to create an excuse to add something as opposed to, why not add it is the best way to optimize that discussion, right? You've got, credit markets that it will give you intel, equity markets will give you intel, currencies will give you intel. And I just think it's really impossible, to do that if you don't have more than one person in the room that knows what's going on.
That's interesting. So what are some of the consistent metrics then in that case that kind of go across asset classes? So as you think about, or I should say asset allocation. So as you think about, so for example, you predictive analytics, how does that play into your team's approach and management style? So thinking about how you're managing your team and what you are asking them to review, look at on a daily basis that goes into the, to the underlying goals of their research process.
Yeah. So I think if at the expense of like oversimplifying, so predictive analytics, I think is a term that a lot of us are just getting sick of hearing it. I think, frankly, right? Like we are all the time. We're big data, and it's not very revealing in terms of what you're doing. If you say that you're doing predictive analytics, or like me, if you have a degree in predictive analytics, right? There's a lot of different things you can do with it. It's like telling somebody that you invest in like mutual funds, right? Like, well, okay, well that doesn't tell me anything. What kinds of mutual funds? And so there are lots of different applications, but fundamentally, you're trying to put guardrails around certain claims, right? If you're kind of a portfolio manager and you're championing an idea, you're basically either saying that this thing is going to keep doing what it's been doing on an absolute or relative basis, right? It's going to keep earning X percent, or it's going to keep outperforming its peer group or whatever, right? So you're either saying that, or you're saying it's going to do that. It's going to do something that it hasn't done historically ever, right? Like it's going to deliver a return or, on an absolute relative basis. So those are kind of like fundamentally the only two kinds of arguments you can make. And in order to support those arguments, you're going to use data or intuition. And both of those are fine, right? But we need to all agree on the rules of the road, right? If someone, said, hey, Mark, given all that, like what would you look at for investment metrics? There are some things that we think are pretty high, like, would have really sort of high coefficients in any like regression model that you make. And one of them is how much personal money, if we're talking to a fund, right, or manager, how much of their personal liquid net worth is invested. That's huge. You don't want people experimenting, with your money. So I'd say how much of their personal money legitimately is invested in this. And we're not talking about fee offsets, like, what's come out of pocket, right? How many deals have been realized, right? Because if absent realizations, you basically just have a science project, right? Which is, again, that's kind of the venture space to some extent, right? If you're an entrepreneur. So that's a different analysis. And then it's references, right? Those things have very, very high correlations on whether investments will turn out. But what we do with predictive analytics is we say, look, you can't model everything, right? You need data to sort of use predictive analytics. Sometimes we don't have data, right? Sometimes you don't have a lot of, it's very ambiguous, right? So we do a few things that I learned from the Good Judgment Project, right, that were really important for me in my formative years, which was, all right, let's get real clear about how we're defining success, right, and how we argue for ideas, right? Again, we're going to use stats, and if we're using stats, let's be clear about how confident we can be in the numbers that we do have, and we're going to use intuition. So let's clearly define success and be very specific, meaning this is going to outperform the Russell 3000 by 5%. You have to provide a time frame, in the next 6 months, and you have to say how confident you are that will happen, 60% confident. And then we track everybody, because what we want to do is just get to truth, right? And so we'll take a portfolio manager or an analyst and just look at all the decisions for which you were 60 or 70% confident. Were you 60 or 70% right? And that keeps everybody honest, that scoring, that social kind of vindication looms large. We find that everybody's overconfident at the start usually, but then eventually they calibrate really, really quickly. But we found that that's a way to sort of de-bias the conversation. And it also de-biases sort of people that are allergic to model-based thinking, right? There's always a guy on the team that's kind of the quant, right? He's run the model and he says, yeah, it is. And I'm 65% confident. And then you've got the guy, or the woman who's going to sit back and say, yeah, I don't need the models to tell me what I know here. I'm, 70% confident the other way. Well, we're keeping score. You get to see, which one's more accurate. So it provides room and space for different approaches to problem solving if we want to get to truth. It also elevates voices of people in the room, because after a while, you start to look at scores and it's like, this person, is not going to take up a lot of room in a conversation, right? They're not kind of the alpha male. They might be younger, right? But if you want to get to truth, we found the only way to do that is to really just be accountable. So we're very specific about the metrics that matter, and then we hold each other accountable, and then we just have various models that help us do that.
That's interesting. Sounds like a lot of character science embedded in there.
Yeah, a little bit. That's a great term.
So as you, I know just reading, some of your, your own work that you've been doing, you've described yourself as an investment ideas person. So whether that's a new investment idea or a new approach to an old problem, can you share for us some of the more recent investment ideas that have been floating around with you and your colleagues? What's been on your plates, and could you expand that on what types of new approaches you're taking to those old problems? I think it's such an interesting, kind of almost like a barbell. You've got the new ideas on one side, but you've got these old approaches that need new methodologies on the other.
Yeah. So, I love this question. By the way, I think the listener should know that when Rob sent over kind of a list of hey, we're kind of going to go down this path. We talked about it, right? So And I told them, I said, these are some of the best questions I've ever been asked. And they kept me up last night. I was just sitting there mulling like, hey, how do I respond to these? And that's a really good question. So let me just address the new ideas, quickly. We're both top down and bottom up. So sometimes we'll have top down research. And one example of that would be when an analyst of ours was interested in cremation, like the cremation space, right? Like, I think it's up and coming. It's certainly very cheap. Kind of do some research into it. And I said, yeah, sure, go for it, right? So, and this is real common. Analyst goes away, does some research, comes back, talk about it. There's some questions. Then we try to figure out, like, if we, to the extent we're constructive, let's say that we are, right? Then it's like, where do we get it? And importantly, we will look at public markets and private markets, because there's no reason for us to lock up capital if we don't have to. So we're always looking at part of the diligence process. Back to the prior question is, what are the public comps for this strategy? What are the private comps, right? And is there a publicly traded company, right, that's got exposure? And because it's like so small, probably not. And who on the private side, right? And couldn't really find anybody. But then we had a deal come to us, that had to do with funeral homes. And because we'd already done the research, it was a co-investment from a GP of ours. We were right on the spot. So sometimes we are top down. Sometimes it results in an idea. And I think right now, from the sort of the top down angle, we were pretty constructive on anything that was that's denominated in a foreign currency relative, right, to the dollar. So the dollar had been at like just historic levels. And when I say historic levels, going back to predictive analytics and being precise and accountable, what we do is we have a dashboard and we just say, look, 1 standard deviation, 2 standard deviations, 3 standard deviations. And if it's within kind of 1 standard deviation, we call that it's within its central tendency. We're not too interested. 2 or 3 standard deviations, and it will come up on our dashboard, because we're following the 4 major markets of equities, fixed income, commodities, and currencies. And we're following mutual funds, ETFs, and single names in the major indices in each of those markets, right? So it pops up on a dashboard. Then everyone's looking at it, right? And then it's like, well, what's going on here? So there have been a few of those, right? So we're very constructive on anything that was foreign currency related, because the dollar was at such historic levels relative to all major currencies. And that one's probably run its course for about 3 or 4 weeks now. So some of that valuation's come back. Been very constructive on biotech, longer term, but publicly traded biotech. The China reopening strategy would probably be another one top down that we've been really constructive on. But then we're also bottoms up. So we work with our GPs, and this gets to, I think, one of your other questions, which is one of the solutions we had to an old problem was like co-investing. So we've been very active co-investors, which was also mentioned at the start, which is a great comment. And the problem is you get co-investors from all your GPs, and some of them are $2 million, some of them are $50 million, and it's just as a team you're trying to figure out, like, well, how do we handle these? Because on the one hand, if you have a $2 million or a $5 million co-investment, if you did 10 of those, right, then you'd have effectively you have recreated a private equity fund with 10 positions and better economics, because you're typically charged either no fee or carry or discounted fee or carry, right? But you don't have the bandwidth to process $5 million, allocations, as first, they're just not going to move the needle, and people are working on bigger things. And what you don't want to do is say, well, let's just like expedite it and just kind of stamp it through, right? It'll be expedited process, because then all of a sudden you look across a portfolio, there's like in the aggregate, there's a big pockets of money where, the underwriting process wasn't as rigorous. So one of the things we've been really successful at that we identified also as a new opportunity was, like, how do we re-engineer this? Like, this is bothering us. It's bogging us down. And so what we've done is created some strategic relationships with partners that we've worked with for some time, and set up these accounts that are very flexible. So we have discretion, and we got sort of allocations pre-approved through our internal investment committee. And we said, look, if anything comes through, it's going to this structure so that they can underwrite it, right? If it's off of our plates. And what we've also figured out is that a lot of our GPs have not so much co-investments that are like deals that are going in the funds, right? And we're exposed to it either way, and we're kind of taking the overage. But a lot of our GPs have opportunities coming across their desk that are just like not eligible for their funds. And we saw that as another opportunity. And that's been, I think, a pretty good hunting ground for us, because it's a deal where they would want to do it personally, but it's too big of a check for them personally. Maybe they want to do it with their family office. Maybe they can't raise LP capital. It's kind of one of those awkward amounts where I'd need 2 or 3, LPs. And we found out, like, stepping into the position and saying, hey, if something comes across your desk that doesn't fit in the fund, is a tremendous competitive advantage for us, because we're providing a solution for them, and we're glad to do it. We've done a handful of those transactions now, and that's an opportunity set that we didn't suspect would be there. That is there, but this happens once we started approaching GPs. I was shocked, how many of these transactions are coming across the desk, and they've been so far, touch wood, it's early days, but some of our top investments, I think we've done like 3 or 4 of them, and they'd probably be like maybe our 3 or 4 best investments so far. And the last one I'll mention, from an industry standpoint, has been more top down, is sports. We've been, I think sports teams and major leagues and what we call challenger leagues, so like esports, et cetera. One of our underlying investments is a soccer team in England called Ipswich Town, which is in the 3rd tier. So if anyone's seen Welcome to Wrexham, they're in the 5th tier, that. But we don't control it. We basically own it through an SPV, and there's a general partner there. But I think all the major leagues, NHL and Major League Baseball, NBA, they all changed their rules in various forms to allow more institutional ownership in the groups. And there's just been an explosion of broadcasting revenue, which has really been pushed down to the teams and the players, and created a lot of wealth. And you have team valuations, right, that are just approaching levels that exceed sort of like the average net worth of your billionaires out there. And they figure out that they need institutional capital, and they like that most of the institutions are governed, right, where financials are public, things like that. So I think you're going to see tremendous growth in like things like pickleball, lacrosse, things like that, and I'm pretty constructive on that space.
Yeah, I think NFL franchises have compounded about 18 to 20% a year for the last 20 years.
You're right.
When you look at that YouTube deal, you look at that Amazon deal, that's setting the groundwork for streaming. And I think these things are all going to double from here, and who knows double, but you mentioned pickleball and everything.
You're exactly right. Look at the Phoenix Suns, right, in our backyard. Just sold to a gentleman from Michigan, who runs a mortgage business.
Michigan State guy, Michigan State basketball player. He,
a little over $4 billion, maybe. I think, was the valuation, and Dial through other, the home court partner is what they call it, right? They invested like a year and a half, 2 years prior to $1.5 billion valuation, right?
And I think they laughed Steve Ballmer out of the room when he paid $2 billion for the Los Angeles Clippers, saying, just a techie coming in, not knowing what he's doing. Compare that trade versus Microsoft. Well, Microsoft's had a good run, but these non-correlated assets are brilliant.
That's the point. I think that people, season ticket holders, people will watch sports. And so there's just an explosion when you think about, all the smaller leagues, right? Like all of the Division II football, basketball, right? High school, all the high school sports. I just think there's a huge kind of sea wave right there that is just prime for institutional capital.
Well, it sounds like a lot of innovation is going on at your plan, so it's exciting for us to hear about. We really appreciate it. Within your answers, though, it was interesting. We were talking, you kind of touched on time horizons. It seems for, again, the students that are listening in who are being taught from me, believe it or not, about venture capital, venture seems to be increasingly looking to deploy funds in companies where they can achieve these returns over a shorter time horizon, so generally 1 to 2 years. What do you think that means for your approach to venture, if time horizons are potentially shortening for a plan like yours? And if you were to give some advice to the students on the line, what do you think that means as they're considering launching a startup in an environment that's looking to achieve 1 to 2 years returns, where historically it was 5 to 7, 7 to 10? Yeah,
right. So I think it's helpful to understand just the context of like the ecosystem. Right. And a lot of the venture funds get money from institutions like ours, not all of them, depending on the size, right? They might have friends and family. It could be endowments, but for the most part, there's someone providing the capital, right? And that's typically where the pressure comes from. And they're competing with other venture funds who are approaching those groups, or those investors are approaching those funds. So there is that competition. And I just think it's important, one, to just understand that that's happening. The fact that that you have put your finger on that and that kids are thinking it through. I mean, the students are thinking that, but that's important to know. And, but look, listen, venture is like always, I think it's like, it's always involved a healthy disregard for reality, right? I mean, it's like, you talk to 100 venture investors. If you're an entrepreneur, you have an idea. You talk to 100 venture investors and they're going to give you 100 ideas about how to redo your pitch book, right? Or how to restructure your idea. And that's going to be very, very frustrating. And I would just say, like, one, it's just important to recognize the reality of the market. Like that's where it is, right? And if you're raising money from that group of people and they're demanding results in 2 years, I think it's important to just to either say, okay, well, we need to go somewhere else, because that's frankly the client. That's what the client is telling you, right? And so I just think going in with eyes wide open as an entrepreneur is just really what you need to do, and lean into it and just accept it and be generous with yourself, because there's always, like I said, there's a lot of luck and randomness in the outcomes, and like I said, you'll get tons of different feedback. From our standpoint, that's not our view at all. We've been very constructive, mostly on kind of like biotech, life sciences. So those drugs take a long time to develop and make their way through some sort of approval process, but even sometimes not. It's just that we've had some drugs acquired just on the basis of science, right? Because the large pharmaceutical companies are effectively like outsourcing their R&D and investing as limited partners in venture funds, and then picking off like promising science sometimes, or drugs that are early stage. So I would not look at venture as, a 2-year one. I think a lot of that came from like the SPAC, sort of the SPAC craze of like last year, where you were coming in kind of late stage and then trying to get the bounce from the public markets. And I think that's gone, or will shortly be gone out of everyone's psyche. I think it's impossible to build a multi-million or billion-dollar business in 1 or 2 years unless you get very, 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 very lucky. What I would think a venture investor might get is an up round, right? They might have a paper gain. But if I were a student, I'd be saying, you might be looking for a paper gain in 2 years, but don't make the classic strategy mistake, which is trading a long-term gain for a short one.
Well, we just have one more question for you, Mark. This has been wonderful. We really appreciate it.
Well, we actually have 100 more questions, but we have to be sensitive to your time. Mark, as somebody that sees allocators all day, every day, all week in our team, you would be a very difficult person to visit with, because we don't try to take more than a half an hour of people's time, but I could sit here and talk with you all day, probably everything other than investments. I mean, this is what makes the business so interesting. It's just meeting the personalities and things like that, but you blend them too beautifully. And I didn't want to say, hey, by the way, Mark, I'm coming through. Can I have 3 hours of your time?
You're so right. I mean, but you're right about like the relationship and the people you meet. There's some like fascinating people in the business. Absolutely, like fascinating, right? And that's been, I think, the most gratifying part over time. It's like you're just at the end of your career, it's like you're no better than kind of your relationships in the industry and your legacy.
Well, what's that classic study that Harvard did? It's starting to get a lot of props these days. They followed the class of John F. Kennedy and they polled all these successful folks. And at the end of the day, the number one determinant of happiness was personal relationships, and money was not even on the scoreboard. So it's just, but I'm interrupting your last question.
You're not. It actually took me into my last question.
Your last one final question.
One final question. No,
Final Jeopardy.
But it did, because it's the personal side of it. I was excited to be able to speak with Mark. My dad started his career as a fireman. He's actually ending his career as a fireman. He's a volunteer fireman in Cape May, New Jersey. He directs traffic. He's not kicking down doors anymore.
He was.
But he was. And he was very excited that I was speaking with you, Mark, as a representative of these plan participants, who put a lot of risk on the table to do their jobs. So my last question is, can you tell me what running towards adversity means to you and your plan participants and to your investments?
It's kind of tough to describe. Let me see if I can, let me show you some interesting pictures. So I mentioned the investment in Ipswich Town, which plays in the third tier. This picture to the right is a picture of the CEO of Ipswich Town FC, and is a police officer who was burned in his Crown Victoria as it was rear-ended, I think back in 2003 or 4. It's a national story, right? Anyway, the CEO, because we at one point thought that we would kind of directly own the team before we decided to go through the SPV route. He said, he's like, I'm really look into a way to kind of rally the team, right? And I said, look, I go, the one thing that will irritate me more than anything else, since we represent people who run into the bullets, right? Like you said earlier, like these people take risks. They run towards the fires, right? They run towards the danger. Use that as kind of the rallying call of the team, right? Embrace adversity. It's going to happen. I think one of the best ways to deal with it is to understand that it happens and to think ahead what happens when you face it so that you're in the moment, you're not panicking, right? And this has to do with soccer. It's been great for the team. So here you see him presenting a jersey, I think, or as they call them, shirts, Jason Schechterly. I think there's a picture here. This is right above their locker room. So all the players have signed it. It's also happens, you can see right here, it's right on the inside collar of their home jersey. And so I've actually been pretty pleased. I wish more of our investors would sort of would sort of understand ultimately the beneficiaries of the program and take that message seriously. A couple of them do a really good job of it. But look, like I said, we don't control this investment, but I was pretty pleased that they were ultimately happy to embrace sort of the ultimate capital source of the team and use that as really sort of the ethos of the team, and that's what it means. So I think it's a special investment. Wish them the best of luck.
I don't want to steal the thunder with your final question, but just it came to me with the promotion and the respect the first responders have always had and are getting more and more. Has the plan seen any donations from just the public? How do I contribute to this plan? Have you seen that? Albeit it might not be a lot of money, but just a few dollars here and there for people saying, you know what, here's some contribution to an entity that keeps us all safe.
Yeah, it's a good question. You can't contribute to the pension system, but I think the best place to contribute is what's called the 100 Club of Arizona. So the website is www.100club.org. And that's an organization that provides financial assistance to families of first responders who are seriously injured or killed in the line of duty. And I think that's the best place for donation dollars, and would heartily support anybody sending money their way.
That's wonderful. Well, we'll be sure to put that website up on the
for sure
on the podcast site, Dakota's site. Mark, thank you so much. This was a wonderful conversation. We greatly appreciated it.
What a treat.
Yeah, thanks for your time, Chris, as always.
I'm tagging along here. Thanks for letting me sit in, and this was just a special treat to sit and listen to a smart investor, but just the whole humanity side, and realize that when we're all calling on people, there's the job at hand, but there's also the relationship and the ability to have a connectivity throughout a career and beyond.
Absolutely. And to our students at Drexel University who stood by quietly throughout this podcast, thank you very much. It was very good for you to join. If you want to learn more about Mark and the Arizona Public Safety Personnel Retirement System, please take a look at their website at www.psprs.com. You can find this episode and past episodes on Spotify, Apple, Google, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. And finally, if you would like to catch up on past episodes, take a look at our website at dakotalivepodcast.buzzsprout.com. And again, thank you for joining us, Chris. Mark, thank you so much. It was wonderful to see you, and we hope to see you again soon.
Yeah, thanks so much for having me, guys.
Don't say goodbye.